Hello, everyone. Welcome to the GCP Podcast Under the Gulmohar Tree. Just as the Gulmohar Tree symbolizes growth and resilience, Under the Gulmohar Tree brings operators, investors, and M&A professionals together to share insights on scaling mid-market businesses. Through candid conversations, we explore leadership, innovation, and value creation, uncovering lessons and strategies to help you grow and thrive. Hi, Glenn. Welcome to the GCP Podcast Under the Gulmohar Tree. For our audience, Glenn is the co founder of Sage Capital Partners and managing partner as well. Glenn, could you share your professional background and the journey that led you to co found Sage Capital Partners in Toronto?
Yeah, sure. And thanks for having me on. So I started my career as a CPA at Price Waterhouse. I was in audit and got interested in M&A and ended up at a small M&A firm in Toronto that's a public company. Became their controller, director of finance, and got a little more involved in M&A there because they were very acquisitive, more on the integration side. And one of the people there kind of said to me, "Hey, you seem like you really enjoy M&A more than accounting. Why don't I put you on a file full time?" And so that's what I did, and I really enjoyed that. And he actually put me in touch with Ontario Teachers. Ended up going to Ontario Teachers and spending the vast majority of my career there, about 14 years. Ended up doing a lot of fun stuff running their TMT group, and I chaired most of their private investments actually for quite a while before I left. And then I joined a small boutique firm here in Toronto. We raised two funds called Imperial Capital. Had a great run there, and while I was there, I started investing in search funds personally. One of our associates left, and he was going to run a search fund, and I had no idea what that was, and he explained it, and I got to be honest, the first time I heard it I thought he was crazy. And then Mario Negro called me, and this is probably like 2015-16, and said, "Hey, you should, if you're interested in investing in this, you should really raise a fund around it. Nobody's doing anything with this." And so I thought he was crazy too, but Mario's a pretty consistent guy, and he had introduced me to my partner John Pirco and said, "You guys should do this together." And probably about 3 years later, we decided that, yeah, this is a good idea. There's a little hole in the market here. We should take advantage of it. And so what we did is we invested a bunch of personal money into deals, including Sumit's deal. And from there, we decided it was a good time to try and raise a fund. And I gotta say, when we first went out to raise a fund, we got a lot of the same reaction that I did when I looked at search funds. People said, "What is this? Are you crazy?" And it was really difficult, but we did it. And, I guess we're 6 years later now, and we've got over $100 million under management. And we've done 16 deals, and we've exited 4, and all the exits have been pretty successful.
That is awesome. Congratulations on such a success in a very short span of time, Glenn. This is incredible. Moving from audit to a controller role all the way to private equity and search funds. Now, maybe let's double click on that. For the audience who may not be familiar, can you shed some light on search funds and how they differ from other entrepreneurial models out there?
Yeah, I mean, they are definitely a different model. And I when people ask me, what is a search fund? They get really, really confused when I tell them, because they ask me, "Are you a search fund? Are they a search fund?" I mean, the search fund model is pretty simple, right? You take someone who wants to be an entrepreneur but doesn't necessarily want to start a company. And so, it's a crowdsourcing or crowdfunding model where a bunch of investors get behind that individual, and that individual goes and tries to find a business they want to not only buy but become the CEO of. So typically speaking, you're looking at businesses that are either family run or entrepreneurially run, and probably have either reached the end of the growth trajectory that person is able to get it to, or is ready to retire and doesn't have a natural succession plan. So that's where search funds fit really well into the ecosystem of entrepreneurship, right? There's a lot of people who get to 65, 70 years old. They don't want to sell their company to their competitor. They want it to keep going. They don't see how to grow it anymore, and they want to retire. And so bringing in a 30 to 35-year-old person to run the company and see their employees be motivated and reinvigorated and the company move forward in a growth path really tends to excite not only us as investors, but also the exiting entrepreneur or family.
Makes sense. But maybe for a minute, let's compare it to other paths out there, like venture capital and bootstrapping a company. How would you compare these three different paths?
Yeah, I mean, if you look at VC, I always say VC is not a bet on black strategy. It's more of a bet on black 31 strategy. It's a very, very hit or miss, and a lot of them are misses. So if you think about venture capital, I recently actually just attended an AI conference, and it's really not a bet on black strategy, but it's a bet on black 34 strategy. It's a very, very, very minute number of people who succeed. So the stat I heard at the conference was 1 in 2,000 startups become what they deemed a unicorn. But then he broke it down further and said it's 1 in, I think, 400, I think was the number, who actually end up being profitable. And that doesn't necessarily mean sold, because there are more of them who are sold and aren't profitable, but it's a very small number that are successful. So if you think about that and compare it to the success of search funds, usually when you buy a company in search, probably about 80% of them return more than the invested capital. And I don't have the stat handy now, but 25 to 30% of them still make over 5 times MOIC. So it's a really different risk perspective to do one versus the other. And then if you think about bootstrap, I mean, again, bootstrap, you are really looking at starting from scratch. And so not having all the support around you, maybe not even knowing what your addressable market is or what you're trying to address as a problem is a really tough thing to do. And so it's really just venture capital by a different name, obviously. So I like search fund because I think it slightly de-risks, or more than slightly de-risks, what you're doing in terms of entrepreneurship. And secondly, I mean, you have a group of people behind you, which you don't have in bootstrap, but you might have in VC, that can help you think about how to grow your company. I think and I'm not speaking just for myself here, so it's not ego, but I think that the boards of these companies are filled with some pretty good people, like people that you could see easily being on much bigger boards, but they take on these opportunities because they see a vision for the company and they want to help entrepreneurs. And so you see people on these boards who have 20, 30, 40 years experience in business, and I think they offer a lot of good advice to the entrepreneur.
Completely makes sense. Now, before we get into the businesses that excite you, can you tell us what are the characteristics of the search fund entrepreneur that you're looking at? While investing, you already have 16 portfolio companies, which means you've invested in a lot more searchers. Maybe can you talk about that funnel and what characteristics of the searchers do you look in?
Yeah, it's an interesting thing. We always try and scientifically break down who do we like, who's going to be successful, who's not. It's really tough, right? We've seen people that we say, hey, I just don't think that person's going to get there, and they do. And we've seen people that we say, this person's an absolute slam dunk, and they end up not being that. So there is science around trying to tick off what school they went to, what their background is, and that leads to a certain modicum of success. So, hey, you worked at McKinsey, you went to Stanford, this is what you've done. Yeah, that's certainly going to be a more successful profile. The problem in Canada is you just don't have that many kids who went to Stanford or Harvard and come back and want to live in Canada. There isn't a pool big enough, so you got to expand the pool and think about people's characteristics and can they do it? Because you don't necessarily need to have gone to Harvard or Stanford to do this right. You just need to have the right characteristics. And so, I think if I broke those down into simple components, I would say to you, I came up with this acronym, and some people love it and some people hate it, but I call it SCUBA. SCUBA means, hey, you're going to go deep on stuff. But SCUBA also is an acronym for me. It means person needs to be smart. There is no substitute for a smart person that's a problem solver. The person needs to coach. So they need to be coachable, and they need to know how to coach their staff. Person needs to be a utility player. So I always say the CEO of a search fund company is a chief bottle washer. You need to know a little bit about every position on the field. So if that's marketing, if that's sales, if that's HR, if that's finance, you need to know about it because you will have your hands in it because you do not have what I'll call a top talent management team. I always say you need to be a banker, and people say, you don't really need to understand everything about finance to be a search funder. And I'm like, yeah, actually you do. You really need to understand your numbers cold because your numbers lead to your decisions. And if you don't understand your numbers and you don't run them through your Excel model and you don't break down where your sales are coming from and where your margins are coming from, you are not going to succeed. So I always look for very strong numbers people. And the last one is the one that everybody always looks at me and says, really? So the A in SCUBA stands for a-hole. You really do need to be a bit of an a-hole to do this. You need to make tough decisions and you need to move forward. That means sometimes you need to let people go. That means sometimes you need to make tough decisions. I've been involved with companies where people were spending money on, pet projects, and the searcher went in and just said, you know what, this is not going anywhere and we should just cut it off. You're totally right. Don't spend money on things that don't make any sense. So that's at least how I break it down, and we figure out those characteristics through a few interviews on our side, and we also try and do references so that we understand what your old bosses think of you. But like everybody else in this industry, we don't get it right. We're not even close to perfect, but we do look for those characteristics, and then the way you refine them is as the person looks for a deal and starts actually searching, as you talk to them, you get more of the outcome of, do they have these characteristics? Are they going to be able to do this, right? Because you're making a search fund investment decision at the beginning, at least, from 2 to 3 hours of interaction. It's that decision as to whether you're going to back them as a CEO that takes a lot more time, and you get a lot more information on that person.
I love the SCUBA analogy, and I can attest to the fact. I mean, you and I have taken many tough decisions together, right? So I'm going to use it. Don't mind, okay? I hope you haven't trademarked it.
I have trademarked it. Everybody loves it.
Awesome. Okay, now the second piece of the puzzle. What criteria do you prioritize while evaluating investments in, let's call it lower end of the middle market, software companies specifically?
Yeah, and in software companies, I always like to look for two things. The quality of revenue, so who are the clients, whether they're SMBs, whether they're enterprise, whether they're individuals, right? So obviously you qualify enterprise as the highest, SMB second, individuals third. So the quality of the ARR is very important. And then the second thing is the retention rates. I mean, retention is really important because every time someone falls out of the funnel, that means you need to sell to one more person to just keep at 100%. And so retention rate is something that tells you not only, hey, this company can continue growing if it retains 100% of its revenue, but it also tells you how satisfied the client is. It also tells you how critical that software is to that business. So if people's net retention rate is over 100%, it kind of tells you have a good product, you have a satisfied client base, and they need the product. As you go down that chain into, like, we've seen many software companies with sort of 75, 80%, I don't say no to those companies, but I think those companies are not necessarily SaaS companies. Maybe they're value-added technology companies, and they're valued differently, and you think about them differently. So I would say to you, again, going backwards, quality of revenue and retention of revenue are the two biggest things for me, at least when it comes to software.
Makes sense. Let's talk about net retention for a minute. We're looking at a company that has 95% gross retention and 95% net retention. Okay, so gross is pretty damn good, right? But the issue is they claim they have no customer success going on. There's not much product development happening. The company is very profitable, cash flow profitable. How would you evaluate such a company? Because there are a lot of best practices that search investors and the CEOs can bring to the table. How would you evaluate such an opportunity?
There's a lot of things that go into the evaluation of that company, right? Like, example, you talk about gross and net retention being 95%. Well, what is it they lost and why, right? I mean, if two of their customers went bankrupt, it goes to the quality of the revenue, but it doesn't necessarily go to the how important this thing is to them and whether the clients actually liked the product, right? It just happens that people go bankrupt. So disaggregating why it's 95%, why the NRR is 95% is very important. You got to break everything down, right? I mean, we've seen companies with 120%, and we owned one with 120% NRR, but their customer retention was like 30%. So what does that tell you? Well, it's a really, really big funnel. You're bringing in lots of people, but only 30% of them stick around and then they really grow with you. Okay, so what does that mean? Well, that means that you don't necessarily have a necessary product. You have a nice to have product. Right away, I would make that conclusion, right? And so that's what we concluded in that case. And so how did we look at the valuation? Well, we looked at it certainly from an ARR perspective, but the ARR valuation was much lower because it's not a necessary product. And then if you ramp forward, you say, hey, at some point I really got to make EBITDA from this company because I know my funnel at some point is going to start to slow, right? That NRR is going to start to slow because a lot of people have already tried the product and your customers came in and they didn't necessarily stick. So at some point in the next 5 years, I might plateau on the huge growth and become a slower growth company, which means I got to look at EBITDA. So you triangulate between those two, as opposed to something that has 100% ARR retention and NRR is 120% and customer retention is 99%. You kind of know you got a good runway ahead of you. So really breaking down why you're losing customers. What is it that the customer is saying when they leave? Looking at the component of that software as it relates to what the enterprises are buying it for. Those are the types of things I think you got to look to evaluate to understand why the numbers are the numbers. Because a number on a piece of paper is just a number until you understand why it is that way.
Makes sense. That was super helpful. Now, let's talk. We spoke a lot about pre-acquisition evaluation. Let's move into post-closing for a second. Deal happens, consortium is formed, CEO is in the chair. How does Sage Capital support entrepreneurs post-acquisition to ensure successful transformations and growth and exit for your LPs? I was there in the chair, asking you many favors, sometimes on a daily basis, and you were super helpful. Thank you for that. But what is your playbook at Sage? Because you guys are obviously not passive investors. You are way more involved, on a day-to-day basis compared to other investors.
Well, thank you for that, and I think we pride ourselves on that. We bring more of a private equity bend to what we do in search, right? So, a lot of search fund investors are looking at like investing in 35 deals and, hey, I know George is going to sit on this board, and by the way, George won't sit on the next board because Dan's on it, and George and Dan know each other, and that's great. That's a model that I think works really, really well. Our model is we want to sit on every board and we want to be impactful because we're in Canada. Canada's a pretty small market. We know a lot of people and we think we can help you. And if that's not good enough, we always say, well, if we take a board seat, we'll probably help you on exit because the tax will be lower for you. So even if we just sit here, we should have some benefit to you. But, we kind of look at being on the board as focusing the searcher, right? So if you're in search, the first thing you're going to do when you close a business is you're going to be the CEO and your hair is going to start to like fall out and you're going to say, oh my God, there are so many things coming at you. And that's exactly what happens. And you create your list of 57 follow-up items and you have them and you think you're doing a great job. But at the end of the day, there's going to be 3 to 4 drivers of your business that are going to make the investment successful. And the job of the board is to come back to those at every board meeting and say, okay, we need to get into data centers, servicing data centers. What have we done this month that makes that easier for us? What people have we met? What data have we analyzed, and how have we moved that ball forward? Those are the things that are going to create value. You know, whether Jill came in with a cold this week and then John didn't show up because his wife and him had a fight. Yeah, those are day-to-day items that happen, but a searcher should have the 3 or 4 items that create value sitting at their desk at all times and saying, okay, I got to do something every single week that moves the ball forward on those. And I think the job of the board is to make sure that that continues to happen. It's that step back moment, right? It's very hard to run a small business and step back because things happen every day. The board's job is to make you step back and say, okay, now I got to move forward and figure out how to make money. And making money really means growing. And so what are those 3 or 4 things that are going to make us grow, that are going to make this investment worth a lot more in 5 years?
Makes sense. Let's look at this from a different perspective. There are many companies which have a longer horizon, right? You need to do a lot more things to, let's say, quote unquote, fix and get it on the growth trajectory, right? The kind of companies we are investing in or buying, they're not really perfect by any means, right? Like many of them don't have growth, or many of them have very low growth. And in the search fund model, you do need growth. It's a growth-driven model to be able to provide returns to the shareholders, right? So how do you navigate aligning investor expectations with entrepreneurial vision of the companies that you invest in, or the entrepreneur's vision? And can you provide an example where this balance was challenging, and how was it managed?
Yeah, that's a very good question, very detailed. Look, we like to do one thing at the forefront of an investment, and I like to do it sort of big picture before closing, and then the first board meeting post-closing really kind of own in on it, which is, okay, how much money do you want to make, right? So you invested 5 and you want to exit and get 20. Okay, so it's 4 times our money, and obviously you got dilution. Okay, so in order for that to happen, your EBITDA is now 2, and your EBITDA needs to go to 6, right? So simple math, right? I'm gonna get a $40 million exit. I'm paying 15 when I get in, and there's my simple numbers. That's how I make my money. Okay, so then let's start 5 years out and say, I need to have a $40 million enterprise business, which means it needs to have 5 million of EBITDA. Now let's work backwards, because you got 2 million of EBITDA. What's the organic growth rate of your business, and where can you take it to? Well, if it's 7 or 8%, you think you can take it to 10. Well, run that math and tell me what you get to in 5 years. And if you run that math, I think you get to like 3.5. Okay, so now you're short $1.5 million, which really means you got to make an acquisition. Okay, so how are we going to make that acquisition? When is the right time to make it, and how are we going to finance it? And so going through those building blocks and looking year after year about, hey, let's figure out, let's plan. And look, plans are just what they are. They're on paper. You don't know if they're going to work out, but at least every year we can look at it and say, yeah, hey, we're on track, or hey, we're off track. What can we do? And that's that big picture moment where you can sit with the CEO and say, listen, we were supposed to do an acquisition in year 2. We didn't, which really means we're a year behind. But not only are you a year behind of buying $1 million of EBITDA, but you lose that 10% growth. So now you're another 100 grand behind. So maybe that acquisition has to be bigger, or maybe you need to buy something that grows more. So it's that kind of discussion that emanates from there. And you said, what happens? Well, we have that exact situation in a portfolio company where we actually laid all this out, and now we're in year 4. And the one thing we haven't done is 2 acquisitions. We wanted to do an acquisition in year 2 and somewhere between year 3 and 4 to get to our EBITDA number, which gets us the right exit. And so we sat down just last week and said, well, why is that? Well, the honest answer is we've tried, and we've had everything from 3 LOIs that one that very often happens, the numbers aren't correct. So you go and you do your diligence, the numbers aren't correct. 2, you have an owner who walked away. 3, you have an owner who wanted more cash at close, and you can't do that. So they're all legitimate reasons why you can't get there. So now the question is are you going to keep going and trying to do M&A or not? And so our analysis of the situation was, listen, we're going to go another 6 months and try and figure out, is there a deal out there we can do, because we think that gets us to the 5 million of EBITDA. And if we don't get there, the secondary analysis is, do we have enough organic growth that it makes sense to hold this company? And the answer was no. And so that leads to the final conclusion. Okay, guys, we're going to go 6 months. We're going to find another company to buy. If we don't find it, we're going to put the whole company up for sale. So that's kind of the analysis we did, that, hey, we're a little bit behind. You know, at the end of the day, we think now we're going to give ourselves 6 more months, otherwise we're going to sell the business.
That was very insightful. Thank you, Glenn. Obviously, not fun for anybody, not the CEO, not the management, not the board, but these situations happen quite often, and more often than people think, especially in the small mid-market companies, right? And especially in technology, where you are investing a lot, you have a competition, a lot of big companies that you're competing with on a daily basis. So thank you for shedding the light. Okay, so it's been really awesome talking to you, Glenn. You and I talk all the time anyways, but this will be very helpful for the audience. As we wrap up, one final question. What advice would you offer to aspiring search entrepreneurs who are interested in pursuing this, let's call it, challenging but rewarding path?
I would say to them just what you said at the beginning. I would say, listen, this is a very challenging and rewarding path. I would tell them a few things. One is, I hate to say it, make sure you understand your numbers, because your numbers are going to convince people whether they invest with you or not. So know them cold. Number two is, it's a really lonely path. So if you're a person that doesn't like loneliness, I'm one of those people. You got to figure out how to surround yourself with people who you can talk to and can help you think through problems, or just have a coffee with you, right? So, you know, on a daily basis, you're calling a bunch of people. 99% of them are saying no to you when you call them. So it is a very lonely and rejecting path. It feels like I did in university going to a bar. So make sure that you understand that those two things exist. You need to really understand your numbers in the company, and it's a lonely path. And I would tell you the last thing is, you're going to get down. So no matter what people tell you, oh, don't worry about it, etc., you're going to get down, and you should put pressure on yourself. And I know that sounds horrible to say, but you should, because every single month that goes by in a search is about 3% of the time you're going to spend searching. And so if you sit there and for 6 months you say, well, yeah, it hasn't been a great 6 months, I haven't got a lot accomplished, you've probably wasted 20%, maybe 30% of your search, depending on how much capital you have, and that's not a good outcome. So do put pressure on yourself to go out and find a deal. I just had this conversation yesterday with a searcher. He's very much in his early days of his search, and he has a very interesting company, pretty much under LOI, and he's looking at another one. And he said to me, I'm only 6 months in, and I really like these companies. Should I move forward? And I say, you know what? Like, you might be 30 months out and have nothing. So if you like a deal, go for it. Don't worry that you're 6 months in. Like, I look at, prime example, Cam and Phil at GLP. I mean, they found that deal while they were still raising their search fund. And they went after it, and I got to be honest, I never thought it would close. And they have done an amazing job with that company. But importantly, they also did an amazing job with their investors, saying, this is going to close, let's keep going. And they dragged us all in behind them, diligence, etc., meeting the owners, convincing the owners they were the right people. So it's never too early to close a deal, and it's never too late to close a deal in search. So make sure you put pressure on yourself to go find that deal.
Awesome. Thank you so much, Glenn. It was such a pleasure having you on the podcast today. I learned a lot, and I'm sure the audience is going to love it. Thank you once again.